Well, Mark and I worked on an idea called the financial accelerator. And the idea basically is that when balance sheets are strong, when banks and borrowers have strong balance sheets, that credit flows more easily. For example, when banks have a lot of capital, they're more willing to lend. When borrowers have a lot of collateral, they are more able to borrow. And our idea was that when times are bad, in a recession, for example, balance sheets worsen because of credit losses, because of falling asset prices. That makes credit more difficult to flow because banks are less able to lend and borrowers are less creditworthy, and that worsens the downturn. And so it was the first idea that changing financial conditions over and above simple changes in interest rates can matter for business cycle dynamics. And that was the idea of the financial accelerator. Have a very similar idea. Their focus is on collateral, on the idea that changing economic conditions, changing asset values affect the amount of collateral that borrowers have when they borrow from lenders, and that in turn adds to the dynamics of the business cycle. They looked at different aspects of the question, but the ideas are quite related. Well, monetary policy works in part through the financial accelerator. So, for example, um, an easing of monetary policy strengthens balance sheets by raising asset prices, for example. Uh, it also strengthens balance sheets by raising economic activity, which in turn reduces credit risk. And so the financial accelerator channel is one of the ways in which changes in monetary policy affect the economy. And Mark Gertler and I specifically talked about how this works through the banking system. So again, an easing of monetary policy makes borrowers more creditworthy. It makes banks better able to lend. And so part of the way in which easy monetary policy strengthens the economy is by going through banks, by increasing bank lending and bank credit, and by improving the balance sheets of both borrowers and lenders. Absolutely. We don't remember now, but there were many people during that crisis who argued that this was a problem for Wall Street. It was not a problem for the rest of the economy. If the financial system went through some stress, that was a problem only for Wall Street. That if a large financial firm were to fail, that the bankruptcy system would take care of that, that the average person wouldn't have to worry about it. I was quite convinced that major instability in the financial system, including the failure of a big firm, would be not only destructive to investors and to Wall Street firms, but would have major implications for the economy as a whole. And that was informed by my study of the Great Depression, and also by my work with Mark Gertler and Simon Gilchrist on the financial accelerator. And so to me, it increased the importance of trying to stabilize the financial system to avoid those implications for the broad economy, which in fact we saw after the crisis worsened in 2008. So that was a very, very important principle that I tried to put into practice. We saw in March 2020 a short crisis that the Federal Reserve responded to very aggressively and stopped that panic. So the Fed has learned, I think, a lot about how to respond to financial crises. But that experience also showed that there's a lot of work to be done to make the system stronger. The problems that arose in March 2020 were mostly in what we call the shadow banking system, in areas like money market mutual funds, bond funds, hedge funds, and some other parts of the system where oversight and regulation are still not as strong as they are in the commercial banking system. So I think that, and I expect that we will see under Treasury Secretary Janet Yellen, a much more active work by the government to monitor those parts of the financial system, the shadow banking system, that so far have not had the same oversight as the banking system. And that is very important. And that's work that remains to be done in the United States. I think the biggest change in paradigm was from the pre-crisis system, where different regulators each had different responsibilities, one type of firm, one type of market, and nobody was looking at the system as a whole. And we have now more of what's been called macroprudential policy, the idea that the financial regulators should not just look at their own little part of the system, but should look at the entire system and look for risks that might be moving between different parts of the financial system. And we've taken steps in that direction in the United States. The Dodd-Frank Act in 2010 created something called the Financial Stability Oversight Council, which is a council of regulators, which is supposed to work collectively to ensure the stability of the overall system. I think that that's an important step. I suspect, again, that with Secretary Yellen, that it will become more active and more focused on the overall risk to the system, and not just risk to individual firms or individual industries. So I think that's a major change. I think there's more work to be done to make macroprudential regulation effective. But that was a big shift that the financial crisis brought on, which I think is very much a good development that will help us protect the financial system in the future.